economics of M&A are about to change. Is the shift to fair value going to generate more or less goodwill? Is the recognition of intangibles going to be more EPS dilutive? Will the new Indian accounting standard on combinations make corporate M&A more expensive? Hello and welcome to Mind the Gap. This week we focus on combinations, and to do that I have with me Seshagiri Rao, Group CFO of the JSW Group, R Ramesh, the Chairman of Deloitte India, and Dinesh Kanabar, the founder of Dhruva Advisors. Gentlemen, to all three of you, a warm welcome. Can I start, Ramesh, by asking you to identify for me the key areas of difference between Indian GAAP on combinations and Indian accounting standards on combinations?
Oh, there are a number of differences. It's almost like comparing a bullock cart with a Mercedes in a way.
Okay.
The earlier Indian standard, which was there, which is AS14, addressed only amalgamations. IND-AS 103, which deals with the subject of business combinations. Combinations could be of different types, including amalgamations, including acquiring, control. That's the first big difference. The second big difference is it deals with the subject of who is the acquirer. It deals with, therefore, with even how to deal with reverse acquisitions. The third is the issue of measurement. And the measurement current in the new standard will be on fair value. The fourth difference is on the date of acquisition, the concept of appointed day and the effective date. Fifth, there is more guidance around contingent consideration. Sixth, and therefore that could have its accounting implications. Sixth, there is a specific treatment on bargain purchase, which was an issue which was left open in the earlier Indian standard. Okay. Seventh, there could be an issue which relates to the accounting for intangibles. And of course, eighth is the transaction cost, which is how to deal with transaction cost is specified. And I could go on. There are a number of them, and that's why I said it's so different.
But
from
8 are enough for half. So we focus on it.
I could go on.
Unless you all would like to add.
And these are just the headlines.
These are the headlines, yeah.
Or for example, you look at contingent liability, which was never required to be recognized. Now you have to fair value contingent liability, which in a sense is subsumed by the point which Ramesh made on fair value accounting.
Right.
So, or for example, impairment becoming mandatory as opposed to amortization of goodwill. So really, number of issues.
Mr. Rao, you want to quickly add what you think some of the big areas are?
No, here once control is changed and once you account the merger on a certain date, then within 1 year they have given a time period of 12 months to make changes based on the actual changes in the consideration. So that is also one very important point in this.
While Indian GAAP is driven by the form of the transaction, the new Indian Accounting Standard 103 focuses on substance. Hence, though it covers all business combinations, it also renders some of them unattractive. For instance, reverse mergers, because the standard focuses on who the real acquirer is.
Once you move away from form to substance, it reduces flexibility, because if flexibility was more in form, you could change the form of a transaction and there are far more flexibility. You never change the substance of a transaction. Now in a reverse merger is more form. In substance, in every transaction, there is an acquirer and an acquiree.
Right.
Only in the past we ignored that acquirer and acquiree and went by what was documented as acquirer and acquiree.
Correct.
Now we have to look at it as on the basis of substance. So the reverse merger was and Dinesh is an expert in this, was a significant tax tool strategy tool to be able to structure transaction.
And that's off the table.
From a tax perspective, a reverse merger continues to be available, because if there were losses and a profit-making entity which really was acquiring it merges, the tax benefits are indeed available. As Ramesh points out, really what now does is it changes the definition of who is the acquirer and who is the acquiree, and therefore really when you do a fair value accounting, you take all those issues into account and nothing else really.
But you can still avail of the tax benefit.
Absolutely.
So it in a sense doesn't change the sort of the variety of deal structures that you have at hand?
Just it could from a tax point of view. For instance, entity A is merging into entity B, whereas the substance of the transaction is B is acquired by A, then you fair value the assets of B. And when you fair value the assets of B in the combined entity, the book profits could be different as you get onto the fair value effect, and its consequential tax effect through book profits could be the only.
So a MAT liability, so for example, just to make it simple, is that tax benefits indeed are available, but when you restate the book profits, you really could get into a MAT liability which is materially different from what it otherwise would be.
Who is the acquirer, who is the acquiree is very important at the time of accounting as per AS 103. In that, if acquirer and acquiree is changing because of the definition of reverse merger here, then there can be a stamp duty implication here, because the assets held by A, now it has to be held by B, because the entire transaction is structured that A is the acquirer, whereas accounting is not saying no, A is not the acquirer, B is the acquirer. Therefore, the fixed assets or the immovable properties of A has to be transferred to B. So in that case, there is a stamp duty implication, and 72 of carry forward of losses in the merged entity. That is also an important element one has to look at. The carry forward losses which are there, which are otherwise earlier assumed as B is acquiring A is acquiring B. So 72A implication also you have to look at.
I think this will be a very material point. So really, does the accounting change the legal form? So when you are looking at the substance of the transaction, does it still change the legal form? So for example, would stamp authorities really disregard the legal form and say what got transferred is not A into B but B into A? And I think we're going to see a lot more written on this, but really I doubt whether that could be the implication. And I do agree with you that would the tax authorities want to really go back, particularly after 31st March 17, when GAR comes into play, to say that really this was the way you recorded it, really a transaction.
I love how you've accepted GAR as fait accompli. I'm not getting into the GAR debate here.
Seshagiri, to also add to the point he's making is, whilst we may be accounting in this manner, it does not necessarily mean the transfer of title has to be in the same direction as the way accounting is moving. Transfer of title will move with the legal form of the transaction, as opposed to the accounting form of it.
Except that accounting is, so tax will not continue to ignore the legal form. Accounting will look beyond the legal form and into the substance of the transaction.
The new accounting standard mandates fair valuation.
Let me make 2 or 3 points here. First is the earlier standard required when you are following the pooling of interest method only to account on the basis of book values. When you accounted on the basis of book values, if you paid a consideration of 1,000 and the book value was 100, 900 became goodwill. So you were left with a situation, you had a huge goodwill to be amortized over a period of maximum 5 years, with exceptions longer. Then when you moved in the old standard to accounting on the basis of purchase method, you had these 2 choices, book value or fair value. Now you move to fair value of the consideration if it's in the form of shares, fair value of assets, fair value of liabilities, fair value of your existing interest in that entity which you have acquired control. You'll have a gain or loss when you fair value there. But more importantly, your allocation of fair value is what we call purchase price allocation. When you keep on allocating the fair values, your goodwill becomes smaller because you have to identify as many assets as possible. Till you have completely exhausted your exercise of identifying assets, including intangible assets, you will not, the residual cannot become goodwill. So there would be more assets which will come onto the balance sheet, and some of them could be depreciable assets, some could be assets which are charged off on consumption, like inventories. Inventories you would fair value, and when they are consumed it hits the P&L faster. So there could be there will be a significant impact as a result of fair value.
And the moment you look at that will be the tax implications arising from that. If I could just make 2 separate comments there. If you now have a common control transaction, then that option of fair value doesn't exist at all. Okay, you are going to do only pooling of interest. So what you see today is a very frequent method of planning on a restructure, where you do a group restructuring, internal group common control restructuring, creating a goodwill, and therefore getting a depreciation on it on the basis of Supreme Court judgment in the case of securities will probably be a dead planning. This is something which has been happening just now. And to take Ramesh's point forward, that when you are doing a fair value accounting on the basis of business combination, there again, the way in which you allocate the consideration, your ability to get a tax depreciation on some of those assets may not necessarily follow what is happening in books.
Okay. Mr. Rao, when you look at goodwill and the fair valuation of, acquisitions, does this change how your strategy to approach M&A?
No, there is a carve out which has been given in the AS 103 itself, that for the past transaction there is an option given whether they can restate the transaction or not to restate the transaction. So therefore, for the past transactions, the fair value replacement is an option that is available. So it's only future transactions we have to look at. So by replacing the book value with the fair value and identifying the correct goodwill after accounting non-identifiable assets like intangibles, the goodwill value may come down. Whether it will have an impact on the P&L and also EPS, that is one area which one has to look at. Clearly there is a deferred tax implication which I am seeing here, because in the IND-AS they have said that balance sheet approach for deferred tax is essential, not the P&L approach. Once you go for balance sheet approach, automatically deferred tax difference between the fair value and the book value that is coming in the income tax, you have to provide for deferred tax. So that will have an implication on the overall EPS and the profit and loss account of the company. So in future, I think these aspects have to be taken into account. Similarly, when you account for intangibles and also goodwill, then goodwill has to be annually to be tested, and also intangibles have to be written off. Automatically, P&L profits come down, you will have the MAT benefit, which can also come in here. So MAT benefit advantage and the deferred tax liability which we provide because of fair value replacement is one area one has to look at.
Another area of focus is intangible assets and their valuation.
What business combination standard forces you to do is, because you have paid a purchase price, you have before you a set of assets and liabilities which the transferor's books shows. It forces you to look beyond that, particularly in situations where your price is greater than the fair value of each of those assets. And in doing that, you keep on relentlessly doing to see, because why have you paid that price? And in the course of that, you will more by actually application of the standard as opposed to the past application of the earlier amalgamation standard, you will bring on to the books as intangible assets which were not recognized in the transferor's books because the accounting standards did not permit, like self-generated brand, customer contracts, maybe a route network, whole host of things, which have two challenges. One is a challenge of assigning a value and measuring that, and the second is the challenge of when it will hit the P&L and its life.
Will the way you look at goodwill and intangibles mean more EPS dilution as a result of a combination?
Yeah, definitely there is one fundamental difference. Earlier when goodwill you have accounted, that goodwill not necessarily to be written off, excepting AS 14. In the balance cases there is no need to write off the goodwill. You can continue the goodwill. Whereas in this case, it is mandatory to test annually as the goodwill is concerned.
Impairment,
there is a likelihood that the debit can come to P&L.
Correct.
Similarly, intangibles. All intangibles cannot be quantified, saying that it is having a infinite life. So there are definitely certain intangibles where customer contract is for a specified period of time, which has a distinct advantage. That advantage you have quantified as an intangible. Then that intangible has to be written off over the life of that particular contract. Therefore, debit will come. So these debits which were not there in the existing accounting standard, when you go for IND-AS, automatically debits will come. So that reflects the true value of the transaction, and also it is EPS dilutive.
So there is a different spin to that. So take for example a situation where you're making an acquisition, it's a business combination. Whether you're going to just make acquisition of shares or you're going to make a amalgamation as an acquisition, could actually make a very material difference on whether it has an impact on my EPS or not, and let me tell you why. So for example, on an acquisition of a share, because it's actually an acquisition, in consol accounts, I will have the same impact, but on standalone accounts, I may not have that impact. And the difference between those standalone accounts and the consolidated accounts could actually have a tax implication. So for example, my tax liability depends on my standalone accounts. There is no combination happening for tax purposes.
Correct.
So each of the two accounts will continue to have its own tax liabilities. But when I consolidate, there could be really, say for example, on consolidation there is a goodwill arising. That goodwill is impacting the P&L account, but has no tax implication
But you pay
whatsoever.
tax on standalone accounts,
Absolutely.
right?
So you have a very peculiar situation. So take an acquisition, for example. You're making an acquisition of a company. It is a business combination. On consolidation, you are going to do fair value accounting. However, your tax liability is happening on a standalone basis. And therefore, your eventual tax liability, so your ETR, your effective tax rate on the profit and consolidation will have no correlation on what is happening on a standalone basis. So you could actually end up on a consolidation basis an effective tax rate which is much higher or much lower depending on the intangibles that you have.
Coming up, we continue to discuss the accounting changes for combinations and their impact on M&A strategy. The new Indian accounting standard on combinations focuses on the real date of acquisition.
Most amalgamations at least had the scheme of amalgamation stipulated an appointed date and an effective date. And the effective date definition was also specified when the last of the approvals, or as the case may be. And if you look at the schemes in our country, the appointed date in some was significantly retrospective. In some cases even beyond a year. So it was really more a deeming fiction as opposed to a reality as to when the merger happened.
And that was done to get a
and
tax
for accounting,
advantage?
the appointed date was chosen and not the effective date of the merger.
So you're able to pretend that you actually did the acquisition a year ago.
Whereas in the new standard, all of it is pre-acquisition.
So you can't pretend that as if this was something that you had acquired a year ago.
Exactly.
That seems fair, right, Mr. Rao?
No, there is only one more implication because of that. In India, what happens is, once a combination is announced, it will take sufficiently long time to get the approvals, legal approvals. Process is very long. So if the control is already taken on the day 1 or day 2, notwithstanding appointed date and effective date, if we leave the discussion for a minute, then what happens when control is changed, automatically you have to account the business combination on that particular day. If anything, if the approvals for any reason is not coming through in the next 12 months, and there is a contingent event because of which the consideration is likely to take, consideration likely to change in future, the impact of that change in consideration on the goodwill or any other area has to be debited to P&L. That implication also we need to look at.
And so are we clear on what it means to acquire control? Look, I know we have several definitions in the country. I know that Indian accounting standards has its own definition, fairly detailed. But does it give you confidence that you can tell in a deal, this is the date in which I actually acquired control? Or is that also a slightly grey area?
No, ability to participate and also change the decisions, I think that is most important. Substance is more important in the participation of the management, not the shareholding.
It is a subjective area. For instance, let's say I acquire 25% and then make an open offer, let's say 35%, and then make an open offer
for
to
another
20%.
Yeah.
When do I acquire control? When I make the open offer, when the open offer closes, when the shares are allotted,
you have to give the answer along with the question.
No, there could be different situations depending on which jurisdiction it operates. So I don't want to get into those answers. All I'm saying is, a control is not when the payment is necessarily made. Control is not necessarily necessary when you've signed a document. There are factors, and that is, whilst it is specified in the standard, all I'm saying is it moves away from the form which you had in the past to say this is the date of control to now having to look at various factors. He mentioned one of the factors.
Mr. Kanabar?
Basically, when you are acquiring a company, it's an agreement between parties. I agree to sell to you today, and let's assume I don't go back at all. Today is my appointed date.
Right.
And as Shesh rightly pointed out, it takes a hell lot of a time. It could be as much as a year before you are able to get all the approvals. So my appointed date is a fixed date. We have Supreme Court in Marshallson saying that is the date on which the assets move for our tax perspective.
The appointed date.
The appointed date. For accounting purposes, you will start recognizing the profits only on the effective date. For tax purposes, that entire profit is your profit or loss on which you got to pay taxes.
From the appointed date.
From the appointed date. My effective tax rate will have no resemblance with my actual tax rate.
The new standard also provides extensive guidance on contingent consideration.
The first part really is that contingent consideration part of the consideration or part of a payment for future actions?
Okay.
That determines whilst you're paying all of it for that business. Let us say I agree to pay you 1,000, I pay you 700 upfront, and I agree to pay you 300 if you achieve certain milestones,
Got it, yeah.
okay, or related to certain employees. The key judgment there will be, is that 300 part of my 1,000 price which I paid for the business which I acquired from you, or is the 300 price which I paid to you for performance or certain actions or services rendered by employees post acquisition. So if it is for services and other obligations for employees post acquisition, then even though I have agreed to pay you as part of 1,000, it will be a charge to the profit loss account. So as I said, these two, and contingent consideration has always this issue of the probability which is attached to any contingency. So the probability has again the elements of when that probability becomes a certainty and its accounting effect thereof. And the second is part of the measurement period which he mentioned, where you are looking at certain events, happenings during a certain period to give you the flexibility of being able to determine what was the position as at the date of acquisition.
This contingent consideration, I think there are two parts into that. One is the deferred consideration, another is consideration which can go up or down based on a contingent event. So as far as the deferred consideration is concerned, it has to be accounted at fair value.
As part of the transaction.
As part of the transaction. As far as the contingent consideration is concerned, that depends upon measurement period. If it is beyond measurement period, it has to be accounted differently. It has to be debited to P&L.
That's how you're reading it.
And then the issue will be really that if, as both Shesh and Ramesh mentioned, that these are the amounts which are being paid and is for future services, and is really therefore debited to P&L account, whether for a tax purposes it will actually be deductible, or will the tax authorities take a view that's part of a consideration and therefore a capital cost?
Mr. Rao, I know that your company is looking to do many acquisitions over the next year or two of power plants. When you look at this new standard, does it change strategically the way you look at an M&A strategy or the imperatives for M&A? Because on the one hand, you might say that, Menaka, what I pay for an asset is what I pay for an asset. That's not changing. But your investors might look at the optics and say, oh, but this is looking more EPS dilutive than earlier. Yes. So, maybe we don't agree with your acquisition strategy anymore. How do you reconcile that?
No, IFRS that way is implemented in several countries.
Correct.
Still M&As are happening, even after accounting at fair values.
Sure.
I agree that when you compare with earlier standards versus IND-AS, there is definitely a change in the way it is to be accounted. It has to be explained to the investors.
Right.
So because of the fair value accounting, additional debits can come to the P&L, and deferred taxes can come in, MAT liabilities can be lower. So those implications have to be understood and has to be explained. But I don't think it will change the overall acquisition strategy.
Okay, so I didn't think that you would change your acquisition plan. But would you nuance your strategy to take into account what the new standard requires of you?
No, I will again structurally change the way we do the M&A. For instance, as Dinesh pointed out, instead of doing a merger by acquiring a company, you can acquire shares in that company, thereby your tax liabilities can be reduced.
Or an arrangement in the nature of a lease. You may get into a transaction in a manner that you get all the benefits of the power plant. You are paying for purchase of power, but it has a finance lease element in it, and IFRIC 4, which deals with that situation, it's an arrangement in the nature of
So would you say that you expect M&A structuring, let me put it that way, to change?
Anything which is dilutive will force entities to look at other options.
I think the way it would happen really is that I'm going to draw up my P&L account for the next 3 years, and I'm going to prepare that under 2 or 3 different circumstances. What does it show if I did X, Y, or Z? So if as acquiring assets versus acquiring share, sale versus purchase, what is the impact both on tax and on EPS, and then come to a considered conclusion as to which is the way I'm going to take.
You're an expert at this, so I'm asking you, do you see new structures evolve out of the constraints that the
Even if there
new
is none, he
accounting
will evolve
standard-
some of them. Don't worry.
Okay.
I'm
Are you
very
intending to
surprised if they
evolve
don't.
new structures based on what could they likely be? Give us a sense of what it is that companies might want to consider.
No, take for example some of the things we discussed. For example, am I really going to acquire a company and merge it, or does it make sense for me to retain it as a subsidiary for a period of time and then merge it? What are the implications of that? So, for example, if I acquire a company today and keep it as a subsidiary, and I do a fair value accounting today, but I merge it after 2 years, the implications are different than what I do it today, because the fair value today now becomes my book value. And the difference between now and 2 years later is not something which I need to record at all when I do the merger. So those sort of things which will keep on coming.
You keep asking all the time as to whether this will change or not change. I can only say this: people change not when they see light, but when they feel the heat.
All right, then. We'll let that be profound last words. Gentlemen, to all three of you, thank you for your time. Next week, we'll be back to talk about tax, that's ICDS, and that will be the finale episode in this series. Make sure you stay tuned.